Hi, and welcome to a new video with Athena Quant. Today, we're going to tackle a huge, and I mean huge, misconception in the world of investing. We're going to dig into why the smartest players in the game aren't just obsessing over massive returns. Instead, they're focused on one thing above all else: mastering risk. You've probably heard this famous quote from Warren Buffett, right? And it's so easy to just kind of dismiss it as being way too simple. But here's the thing, it's the absolute bedrock of all serious investing. We're all conditioned to chase the biggest gains. But what if the most successful investors are playing a totally different game? A game where protecting your capital isn't just one of the rules, it's the only rule that guarantees you get to stay in the game long enough to win. And this slide right here, this gets to the very heart of the paradox. I mean, think about it. You could have the most amazing, high-return strategy ever created, but if it doesn't have serious risk management built in, it's basically a ticking time bomb. One bad streak, one unexpected market event, and poof, it's all gone. But on the flip side, a decent, even a kind of mediocre strategy with excellent risk management, that's the one that survives. And because it survives, it gets to use the most powerful force in finance: compounding. Survival is everything. Okay, so let's get practical. Let's dive into our first key concept and see how the pros actually quantify the most painful part of this whole journey. Because what gets measured gets managed. And that measurement is called the maximum drawdown. Put simply, it's the metric that tracks the absolute worst-case scenario your portfolio went through. It answers that gut-wrenching question from its absolute highest point: what's the most money I could have possibly lost before things turned around? It's a raw measure of both financial and, let's be honest, psychological pain. Now, here's where it gets really interesting. This slide shows the brutal, unforgiving math of losses. They call it the asymmetry of loss. If your portfolio takes a 50% hit, you don't just need a 50% gain to get back to where you started. No, you need a 100% gain. You have to double your money just to break even. And that right there is why avoiding those big losses is so critical. The climb back is twice as steep. So if we know that dodging those huge losses is priority number one, how should we be evaluating our returns? It's clearly not just about that final percentage. All right, let me ask you a quick question. Just looking at this, which strategy seems better? I mean, strategy A looks like a no-brainer, right? 20% versus 12%. But as you've probably guessed, there's a catch. And boom, here it is. Once we factor in the risk you had to take, which we can measure with volatility, basically the size of the swings up and down, the whole picture just flips. Strategy B is actually way better. The Sharpe Ratio makes this super clear. It measures your return for each unit of risk you take. A higher number is better, and look at that. Strategy B is far more efficient. It gives you more bang for your buck with a much smoother ride. So the main takeaway here is this: big, flashy returns are totally meaningless on their own. Professionals don't just ask, what was the return? They ask, what was the return for the amount of risk you took? This idea, risk-adjusted returns, that's the real standard for measuring how well you're actually doing. All right, let's bust another huge myth. This is one that trips up so many people when they're starting out. It's this obsession with having to be right all the time. So I want you to really think about this for a second. To be a profitable trader, do you need a high win rate? Do you have to be right 70, 80, maybe even 90% of the time? Common sense would scream yes, right? Well, the reality is a huge, resounding no. And this table just lays it all out perfectly. Check out strategy A, a mind-blowing 90% win rate. But it loses money. How is that possible? Because those few times it's wrong, the losses are catastrophic. One single loss wipes out 9 wins. Now look at strategy B. It's only right 40% of the time, yet it's super profitable. That's because its average win is 5 times bigger than its average loss. See, it's not about how often you win, it's about how much you make when you win versus how little you lose when you're wrong. And this leads us to a much, much better metric called the profit factor. All it is your total profits divided by your total losses. It perfectly captures that critical relationship between the size of your wins and your losses. And, as a rule of thumb, a profit factor over 1.5 is usually a sign of a pretty healthy system, no matter what its win rate is. Okay, so we've got all these concepts: drawdown, Sharpe ratio, profit factor. How do we put it all together into something we can actually use? Let's take a look at the professional's playbook for protecting their capital. It's all about having a hierarchy of defenses, like layers of armor. It starts at the smallest level. Every single trade has a predefined point where you say, I'm out. That's step one. Then you zoom out to the whole portfolio, making sure your total capital at risk never gets out of hand. Level 3 is like a circuit breaker for your entire account. If your drawdown hits a certain number, you stop. And finally, you're constantly evaluating the whole system, checking its vital signs, making sure those risk metrics are still healthy. And all of this really leads to a fundamental shift in mindset. For a true professional, the game isn't about hunting for the next big thing. It's about playing defense. They spend the vast majority of their time, maybe 80% of their energy, just on managing risk. Why? Because they know that if you protect the downside, the upside will take care of itself.
So, I'll leave you with this one final thought. The next time you're looking at an investment or your own strategy, just reframe the question you're asking. Stop asking, how much can I make? And start asking yourself, how much can I afford to lose and still be able to play tomorrow? Because that shift in focus, that is the real secret. Thanks for tuning in.